Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, Mark Slater, the Chairman and Chief Investment Officer of Slater Investment, joins me. We discuss the UK market, how to invest in it, and what the government should do to make it a better market. Mark, thank you so much for joining us today. Very kind of you to come in.
Pleasure.
Now, you have got three different funds at Slater, right? You've got an income fund, a growth fund, and a recovery fund. Now, when we look at these three things, what does it all mean? I want to start by talking about the difference between these funds, what it is that you mean by growth, particularly when if you're investing in the UK, almost everything is what we used to call value, right? So what's growth, what's income, and what do we mean by recovery?
The income part is very simple because it literally is, that is a strategy which represents a relatively small part of what we do that is seeking what we call good and growing income and some level of capital growth at the same time. So that fund pays a pretty significant yield premium to the UK market, around 5.5%, versus the high threes for the UK market. And some capital growth.
And that's where we're going to interrupt you immediately to say, so those will be mainly large companies.
No, that's across the market cap spectrum. Something like 90% of interesting yield opportunities are outside the FTSE 100. So we're looking right across the piece for that strategy. But we have about a third thereabouts in FTSE 100, but we have a good chunk outside. On the growth and recovery side, both of those funds are basically our growth strategy. The recovery fund is smaller and therefore focuses on slightly smaller companies. But they're basically the same strategy. And what we refer to as growth, and always have done, by the way, so it's our 30th year, is buying growth cheaply. So we're very much at the intersection of growth and value, whatever those terms mean, because obviously they mean a lot of different things to a lot of different people.
Well, I always look at that and I think, well, surely everything is value. Is there anything except for value? It might be in the eye of the beholder, but who on earth would buy a stock if they didn't think it represented good value?
Exactly.
So the terms are basically meaningless.
They are, but I would say, if one were to caricature, you would say, some people regard growth as momentum-driven, very high multiples, that kind of thing, and they regard value as sort of cheap but utterly hopeless and in decline. Those are the extremes. What we're looking for is decent levels of earnings growth, but at a reasonable price. So we're looking to pay a relatively low multiple in relation to the growth rate for the companies we buy. I would say in the last few years, we've had a very different market complexion where suddenly even quite dynamic businesses are priced as if they have no prospects whatsoever. So they're priced on very low multiples. For us, our ballpark has always been somewhere between a 10 and 15 multiple of earnings, a PE multiple. In 2021, we were at the upper end of that. We can go up to 20 times on a prospective basis, but that's not something that happens very often. So in 2021, we were at the upper end of that 10 to 15 range, typically for a new holding. These days, we're at the bottom of that range or below it. There's a plethora now of single-digit multiples where you've got a very good business. So these days, I think if growth and value didn't have much meaning in the past, I think now they really have converged in the UK.
In the UK, Lisa, you must have the most spectacular hunting ground in the UK at the moment.
Yep.
The index is absolutely jammed, particularly the FTSE 250, with very high quality companies with reasonably fast growing earnings trading on very low valuations. Not quite as low as they were, admittedly. 18 months ago, valuations were even cheaper than they are now. But nonetheless, given what you've just said, this should be the most perfect time for your style.
I agree with you. Yes, there have been little moments here or there where things have been cheaper. The day after the Truss budget, markets were obviously cheaper. But if I look at the 30 years I've been doing this professionally, I would say right now, give or take a few percentage points, yes, it's spectacularly cheap. And the other aspect of it, which is really interesting, and this is, again, something that's fairly unique for me, I haven't seen this before to this degree, is the disconnect between public and private market valuations. The private equity players are rubbing their hands with glee, and that's actually been a real problem in the last 18 months or so. A little bit less so now because there's a slight change in the mood for the better. But you go back a year and boards didn't feel they could resist a premium. Now, a premium to a really low number isn't very clever, but that's what we were seeing. And a lot of fund managers needed the cash. So they were accepting deals they should never have accepted, go back into last year. I think that has got a bit better this year.
But it is an extraordinary idea, isn't it, that a privately held company should have a valuation premium to a publicly held company, because it's total upending everything that I ever believed or was taught or was told, which was that a publicly listed company, given its liquidity, should trade at a premium to a private company. And someone said to me only a few months ago, they talked about the liquidity premium, and what they meant was the lack of liquidity premium. And that was an absolutely extraordinary thing.
Yeah, I totally agree. It's not meant to happen, but it's happening here.
And why has it happened?
It's interesting. I mean, if you go back to 2021, prices were relatively high in a lot of asset classes, including UK mid and small cap in some pockets. When rates changed, we fully expected there to be some impact. And particularly, we expected it to be amongst high multiple companies. So the surprise has been that it's hit high multiple companies, but it's hit low multiple companies too. And there hasn't been much distinction between companies that have had some kind of problem and some companies which haven't had a problem. So that's a huge surprise. I would say the reasons are partly fear of recession over the last couple of years. What concerns about earnings growth or the quality of earnings, that's been an issue. I think on top of that, you've had the almost doom loop around flows, where outflows create selling, which create poor performance, which create more outflows. There's been an element of that. That's a bit better than it was today, but it was definitely a factor in 2022 and 2023. On top of that, you've got the kind of mania around large cap tech in America. That's sucked a lot of money out of pretty well everything else. On top of that, we had the trust budget, which I think just at a time where the UK was beginning, the perception of the UK was just beginning to improve. That was obviously a big setback. So lots of different things have happened. It's been the same in Europe to a degree, but I don't think quite as badly.
Yeah, it feels like we've had more of a discount in the UK.
I think so.
Yeah. But people are noticing.
Yeah.
And it is changing. We're beginning to see boards take control themselves. We're beginning to see a sharp rise in buybacks, right, which seems like a very efficient thing to do at a time like that.
Yeah.
And we haven't seen significant buybacks in the UK in the past.
That's right.
And we're also seeing rising M&A, rising bids for smaller companies, etc.
Yeah.
And possibly maybe the beginning of some inflows back into the UK market, or at least the end of the outflows.
I think the flow situation has significantly improved. In the industry, there have been 1 or 2 months where there have been signs of life, and then you find the next month it's sort of not so good. But the bad months are no longer very bad. So there's a slight improvement there. What's interesting, actually, outside the fund data, there are bigger flows into passive UK products like mid 250 indices and things like that. So there's definitely some interest in the UK now that there wasn't before. We do quite regular investor meetings and lunches and webinars and things like that. And we have found in the last year that attendance has rocketed, and pretty well everybody there is very interested in doing something about the UK. They recognize it's cheap. They recognize they're underweight, but they're all waiting for a catalyst. Everyone's sort of waiting for someone else to jump. It's a bit like the sort of penguins in Antarctica, when they're all waiting to get in the water. And so there's a nervousness, but there's a lot of money on the sidelines that could move very quickly. So I think there's a lot more interest. The valuation piece, I think it's interesting when people talk about catalysts, because I think when something's very cheap, you shouldn't be too worried about a catalyst. It's going to come. Valuation in and of itself is a pretty interesting catalyst. It's the most important.
People are often not prepared to wait, are they?
No,
this is one of the problems with the fund management industry, and we always say that retail investors have this great advantage over institutional investors because they can afford to wait. No one's judging. No one cares. They can buy things that are cheap and just sit around and wait without endlessly wibbling away about catalysts, because it doesn't matter.
Yeah, that's true. To me, the interesting thing is, I think the smart question would be, what is the catalyst, for example, for NVIDIA to double again or whatever? But for very, very cheap companies on low multiples, the risk is low.
I mean, you might say in the UK as well that the big sellers have finished selling. So we're just waiting, right? We're sort of plateaued. So the pension funds have probably finished selling. The insurance funds have finished selling. They've been selling down their UK stakes for years and years and years of practically no home buyers at all. In fact, no home buyers at all. Negative home buyers. Negative home buyers, most of them. So they can't really sell anymore. The defined benefit pension funds have nothing left to sell.
Yeah.
So that negative is effectively gone. And defined contribution pension funds, the assets inside those are rising, and they tend to have a little higher allocation to the UK. So that makes a difference, a gradual one, but a difference in terms of weight of money coming to the market. Yeah. So it's as much the negatives have been removed as anything else.
Very much. And I think a few others have been removed as well. So if you go back 2 years, the narrative was very much that the UK, there was a kind of UK exceptionalism where the UK was extremely bad and a complete outlier even in Europe. Now, that narrative was actually just wrong.
But it was never true in the first place.
It
just somehow developed.
Well, I think it was all tied into Brexit, and a lot of the people who were anti-Brexit sort of pushed that narrative because it sort of made them feel better. But the reality is it wasn't true. And for a couple of years, that's gone. That narrative is completely gone because the data for the UK is kind of in the middle of the pack for a European country. So it's not brilliant, by the way, at all, but it's just not exceptionally bad.
You can't suggest that it's specifically worse than anybody else because of Brexit or because of any one factor.
Exactly.
And you also can't do the thing of looking around and saying, oh, look, the UK is in political chaos and everywhere else is stable, because that, of course, isn't true either.
Exactly. So I think we've had a shift in the narrative and the mood around the UK about the general economy, which is significantly positive. It was seen as uninvestable in 2022. And now it's a very big shift to be seen to be investable. Whether people do it or not, it's another matter, but that's a very big psychological shift. I think on top of that, as you say, the election, whatever one's preference is, it was boring, and boring is good. So I think that was a positive. So I think a lot of the pieces of the jigsaw are in place. And the other thing is there's a lot of resilience amongst UK companies. The UK has been in a sort of, not a technical recession, but it's kind of felt like a recession for quite a long time. And businesses are used to operating in that environment. Combine that with low valuation, they've taken an awful lot of pain. So, of course, there are circumstances which could be negative, but I think an awful lot of that is in the price.
Yeah. Someone suggested to me earlier today that one of the reasons that UK companies are so resilient is because management became so much better during COVID. Managers really learnt to understand their companies and the dynamics of their companies and every little detail of their companies in a way they wouldn't necessarily have had to at any point pre-COVID. So coming out of COVID, or not out of COVID itself, but out of the pandemic regulations, etc., that changed the way they were able to manage companies and made them much more resilient.
I think that's
coming
true.
into the following years. Is that fair, or is that just...
I think it's fair, and I think there's a very significant contrast there between the private and the public sector. You know, I think companies got lean and mean in that period, and I think the public sector did the opposite, which, you know, for a whole lot of reasons. But no, I think it's true. I think companies, and not just COVID, also coming out of COVID was very complicated for a lot of companies, particularly around supply chain, and it's been tough. They've had an awful lot thrown at them, and they've managed. Throughout the last few years, whenever we met companies, with the exception of the worst moments in COVID, where people really didn't know what was going on, but outside that extreme moment, when you met with companies, they weren't complaining about the economy or any of these other factors that one tends to read about. They were just getting on with it. And that's what companies do. Yeah. That's one of the nice things about meeting companies. They tend to be quite positive, and they're just getting on with the work they have to do.
Okay, so you've got pleasantly valued, very resilient companies sitting in an environment where what could go wrong mostly has. Although I would say there's probably a little political risk in there. We've no idea about the budget in October. There are an awful lot of things there that may look unfriendly to business, unfriendly to growth, and this idea that the UK is now a stable place. That could be derailed. So there is political risk.
If you talk to a non-dom, they will definitely share that view. They would definitely say that they're very worried about things. But there aren't that many.
There aren't that many of them. But there are other people may be worried about capital gains. We may see people selling their UK equities, for example, ahead of the budget to crystallise capital gains in advance of the rate going up. So there are niggles about, and there's some concern about the direction of travel. But nonetheless, optimistic point of view, we've got a politically stable country with a perfectly reasonable economy. interest rates very likely to come down further very soon, and most of the world in a rate cutting cycle as well, and great valuations. So it would be entirely reasonable to think that you could see a fairly nice couple of years coming from UK small and mid caps in particular.
I think so, and the data's also supportive on that. One can't invest on this basis, but it's interesting. Historically, when particularly the small cap space has a bad period for 1, 2 or 3 years, the following years are normally very strong. It's pretty good at bouncing back. So it tends to exaggerate in both directions. So that's what I would expect. Having said that, I didn't expect what happened in the last 2 years. So,
no.
So I'm not putting myself forward as a sort of soothsayer, but I think the facts are very supportive, very supportive.
Okay, let's go back to the problems of the UK market as a whole and a potential catalyst or not. I mean, there's been a lot of discussion in the industry and among politicians over the last couple of years about what can be done to make the UK market a better place to invest. And if you talk to an international investor, they'll very often tell you that, yeah, it looks fine, but the liquidity isn't there. They can't quite cope with it. Or they worry about stamp duty. They worry about the fact that the UK is one of the highest stamp duties in the world, and they worry about the government not necessarily producing some kind of signal that they support the market. I mean, I felt that the cancelling of the Brit ISA was a very bad idea. I don't know what you thought about that. But there should be something that we can do to create that catalyst for the UK market. What do you think that should be?
Well, I think it's necessary now. I agree with you with the British ISA. I mean, yes, it was messy and complicated and all kinds of issues, but it was a statement of intent. And I think that
exactly,
to me,
it was a signal.
That was important.
Yeah.
There are much bigger ways that could be done. But I think the first thing is to try and work out what the problem is, because there are a lot of false narratives around the UK market. And I imagine the average politician assumes that these are the kind of basic assumptions are we're bad at taking risk and we're bad at tech. And they look at the FTSE 100 as if it's representative of the entire UK market. And I think that's wrong. Yes, a few companies have listed in the States. They typically are actually companies where all of their activities are in the US, so it's not a particularly unusual phenomenon in my view. But the real issue is that underneath the FTSE 100, it's sick. The patient is sick. It's been hollowed out over the last probably 20 years, but in particular over the last 5. The fledgling index, it has lost 75% of its constituents in the last 5 years. If you exclude investment companies, which aren't businesses, the small cap index it has lost half of its market value, ignoring again investment companies. So it's not going to exist in a few years on
this
that basis.
This is again because people can get money elsewhere. It takes us back to private equity.
The
waves of private money that can so companies don't need to list because they can get hold of the money earlier, private equity can take them off because they can buy them out at a premium, and management hasn't got the energy left to put up a fight.
Yeah, that is a sort of the diagnosis in the sense that there is sickness down in the lower reaches of the market, and it's a problem that in the same way. If a tree didn't have roots, it would be a bit of a problem. I think it's also analogous to the housing market. When for the housing market to succeed at the very top level, ultimately you need health at the very bottom as well. It ripples all the way through. So I think there's a real issue down in the lower reaches. I think that the solution is actually very simple. It's a lack of capital. The UK is the only major stock market on earth that doesn't have around half its ownership in domestic long-term capital, either pension funds or insurance companies. We used to have half not that long ago, maybe 30 years ago. Now it's down to 5%, roughly. And that's unique. Nobody else does that. Nobody. And that is a problem. And basically, another way of looking at it is we've had roughly $1 trillion of outflows in the last few decades in the context of a market that's worth just over 2 trillion. So it's very significant. And it's for a whole lot of reasons, but a lot of it relates to errors by government and regulators over many, many years. And I'm not a fan of government interference in markets, but when they make a mess, I think they have to think about whether they put it right. And I think the starting point has to be, do we want a stock market at all? Because on the current direction of travel, we will not have one in a meaningful sense in 5 or 10 years.
Well, there's an interesting parallel I was discussing with someone the other day about regional stock markets in the UK. And as you know, we used to have so many regional stock markets. We had Aberdeen, Dundee, Glasgow, Edinburgh, Leeds, Birmingham, Manchester. I'm sure there are more. And the last ones disappeared in the mid-'80s with the Big Bang. Yeah. But also they gradually withered away because London became the best place to list and the place where there were the biggest companies, most expensive companies, most interesting companies, etc. And the ones that were listed elsewhere just so slowly disappeared. Everything gravitated to London. And there is a suggestion that this could happen globally as the London comes to New York as Dundee was to London and gradually drifts away. So the question, do we want a stock market at all, is no longer ridiculous.
No, it's not. Well, I think the question whether we will have one is a very live question. I think the question is whether we should have one. The answer is very simple. I think it's a straightforward yes, because, I mean, if just take a few simple examples. If private equity buys a company, a public company, the day they complete is the last day they pay corporation tax. They don't do it anymore. They load it with debt. They offset the debt against profit. And that, if I were in government, I'd find that pretty irritating. Also, you've got a lot of disclosure. It is a source of capital. I mean, yes, there are other sources of capital, but it's still a source of capital. And it's also a massive provider of wealth and a big contributor to GDP. The city writ large, I think, is something like 13% of GDP. It's something like that. It's an enormous number. And I think 700,000 jobs in the country, in London and outside London, are linked to it in some way.
And those are high-paid jobs.
It's important. And I know, it's fashionable for people to bash bankers, but they're not all bankers. They're doing all sorts of things.
So in essence, having deep and liquid capital markets is extremely important to GDP growth overall.
I think it's essential.
And to pretend that it's not is just silly.
And also, what's interesting to me is Labour needs money to fulfill its objectives. So, for instance, on the green agenda, I'm not an expert on this sort of thing, but they've had to significantly reduce their ambitions. If we had a thriving stock market, that will be another tool in the kit for government as well. And what fascinates me is, yes, there's lots of focus at the moment on the rules and whether shareholders should be able to vote on related party transactions or whatever it might be. The rules are yes, there's work that needs to be done, but they're kind of irrelevant. And I've pointed this out to some politicians I've met over the last year or so. And, I asked them the question, why is it that practically every big fund manager on earth is camping out in Riyadh at the moment? Is it because they like the rules? Or is it because they think there's a big pot of cash and they can get their hands on some of it? And it all comes down to cash. If we have large amounts of domestic capital pointed at the UK market, everything else becomes possible. And the money's there. It just needs to be repurposed.
So are you suggesting that the government directs pension funds to invest in the UK market? Are you suggesting an element of compulsion?
My view is if government is giving tax relief, they have the right to attach strings. I don't like the idea of government telling people where to invest, but I think where they're giving tax relief, people don't have to take the tax relief. If they're giving tax relief, I think then there's a very strong case for setting some rules around that. And it's not as if others don't do it. Plenty of countries have done this sort of thing successfully. One of the simplest areas is ISAs. ISAs, the original ISA, the PEP, had an you had to invest in the UK. I think it was either 50 or 100% had to be invested in the UK. That's been removed. Why not bring it back? There's 250 billion of ISAs in non-UK equity products. That's a lot of money in the context of our market. I think the pension fund sector is more complex because you've got some of it's in runoff, some of it's not. So I think one would have to focus on the areas where cash is coming in. But again, if tax relief is being given, I don't think it's unreasonable to set conditions. Similarly, with insurance companies, it's a slightly different thing. We have the Mansion House Compact already with this 5% target, which I think is very low. I think that should be a higher number. I think it should also very explicitly include quoted companies as well. 10, 15 years ago, people used to talk about matching liabilities from a currency perspective. No one ever does that anymore. Because the US market's done so well in the last 10 or 15 years, everyone's conditioned by that. Interestingly, those people weren't weren't talking about buying the US 10 or 15 years ago. It's all backward looking. But I think that there's a strong argument for matching liabilities. And there's also a very strong argument for using the Australian superannuation playbook, which I think is obvious, where these massive funds, these massive pension funds in Australia, they started out where they had to invest all the money in Australia, public and private assets, infrastructure, things like that. They became so big they had to branch out, but they still have a very big proportion in Australia. And interestingly, if you're a trustee of one of those bodies, every year you have to write a report and you have to explain how your investment actions have benefited Australia. And the argument is that it's beneficial to an Australian retiree to be in a country that's working. And if infrastructure is required, then it helps them. It's not just about the financial return.
Yeah, no, it sounds a little like financial repression, but I'm afraid I rather agree with you. I mean, in fact, we're having a bit of a meeting of minds. I wrote a column last week about the Brit ISA suggesting that instead of abolishing that, you should abolish all the rest and put the entire 20,000 a year only into British listed stocks. And then the response to that was very much, well, what is a British stock? What do you mean? Because most of the FTSE 100, as you know, a large percentage of the revenues come from abroad. And what about an investment trust? That's not a UK stock, etc. And I rather feel that was to completely miss the point.
Totally
the point
agree.
just being to pour money into the UK market to increase its liquidity, to increase its depth, to benefit the economy as a whole. It doesn't really matter what's British and what's not.
I totally
What
agree.
matters is that it's UK listed. That was my feeling on it.
I totally agree, because I think the market is under pressure. Obviously, there have to be some thought about the rules and all that. But I think it makes perfect sense that, funds investing in the UK, companies which are listed here, investment trusts which have a focus here, all of those things are fine. And maybe there have to be certain thresholds, but it's,
I'd say no thresholds. No thresholds.
no, I think to get it done, I'm with you. But even if there were thresholds, it wouldn't worry me. The key thing is just to do something. And I actually think one of the benefits of Labour is they have just in their DNA, there's not really an issue in terms of doing mandatory action. They're forcing people to do things, whereas the Conservatives were much more hands-off in that sense. It would worry me if they start telling people how they invest their money in a very
but as long as they're
way.
in a tax wrapper.
If there's a tax wrapper, I think there's a very strong argument.
Capital controls would be a problem,
Yes.
but things inside tax wrappers, absolutely not. So financial repression light, we'll call it.
It's fine.
Yeah, it's fine.
But I think it's in everyone's interests.
Yep,
I think
I totally
it's
see
a
your
no-brainer
argument.
in my view.
Well, let's see if it's a no-brainer in their view. We'll find out over the next
I
few
hope
months,
they
won't
agree.
we? I mean, there's definitely a shift in that direction. And
I think so.
I think it's well underway already, but we'll find out shortly. Listen, let's move on to slightly more fun stuff and talk about some of the stocks in your portfolios. I know you don't invest by sectors. You don't necessarily have an answer to this, but do you find that your stock selection is leaving you at the moment with a sectoral bias? Sectoral bias. You know what I'm trying to say.
No, not right now, not really. We have had that over the years. It does happen occasionally. But nowadays, most sectors, they're not that meaningful in the sense that, I mean, in the part, we're not invested in house builders in any real meaningful sense at the moment. But we have had a couple of periods where we've been very heavily in house builders. And they're kind of all the same. It's a very homogenous sector. But there aren't many sectors like that. So where we have sector concentration, it tends to be in areas, like support services, which really is a catch-all for a whole lot of different types of companies, which don't have a lot to do with each other. So not really at the moment. There's not really a sector theme. The companies we own are really in all sorts of different areas, typically with some sort of niche, typically with an obvious focus, but not really a sector.
Any interesting
focus.
recent acquisitions we can talk about?
I made a rather surprising investment earlier this year in Glaxo, which is not
This
exactly
doesn't
a very
fit
tiny.
any of the things we've been talking about.
Well, yeah, but it's on a very low multiple, and it's growing around 10%, and everyone hates it, and generates cash. It does all the things we like. Every quarter, there's been improvement probably for 2 years. The management's doing a great job, but no one is interested. So I was very happy to own that business.
Why do you think no one is interested in a business like that? Well-known, good brand recognition, as you say, growing fast, reasonable multiple, dividend.
It takes a long time. We had the same thing with AstraZeneca going back a long way. There was a bid from Pfizer. I think it must be 2013 or 14. We owned the company at the time, and the bid was defeated. And the new chief executive did a brilliant job, and now no one wants to hear a bad word about AstraZeneca. And it's on a fantastic rating. It doesn't have any of these sexy weight loss drugs, but it's still on a fantastic rating. And Glaxo, I think, is in a similar position. I think they're doing all the right things. It's just that there's an element of show me. There's an element of sort of they have to prove it. The other fly in the ointment is there's litigation around Zantac, which is a concern. I mean, you can't ignore it, but it's massively discounted in my view.
What's the biggest holding in the small cap fund?
The biggest holding...
Well, not small cap, growth fund, I mean.
Yeah, the growth fund. We've got several holdings around the similar sort of size, but the biggest holding right now is Serco, which it's a mid-cap company. It's got a fantastic cash generation. It's got a sort of 8, 9, 10% free cash flow yield. It's been generating nice, steady growth for quite a long time. Good return on capital. So all the things we like. They're retiring around 7% per annum of the equity on top of all that. And it's just very prudently managed, not popular, but they just steadily do their thing. So we bought that position around coming out of the COVID pandemic because they did a lot of they were one of the big COVID beneficiaries, but obviously that revenue was kind of one-off in nature. And it was interesting. It kind of put people off. But the fact they'd done so well out of COVID, people didn't like that because they knew it was going to fall away. So all of our analysis just stripped COVID out as if it had never happened. And the underlying position was very nice, very healthy. So that company we've owned for since that time, and it's done really well.
Okay, interesting. And then the recovery fund?
Biggest holding there is a company called Franchise Brands that has a few activities, but the primary activity is hydraulic hoses, which in certain types of business you need them, and sometimes you need them very quickly. And they own a business called Pertec, which is a franchise business, but in most countries in Europe, and it's a market leader. They also own Metro Rod in the UK, which is a sort of plumbing related business. Run by Stephen Helmsley, who is the man who built Pizza Express from a £3 million company into a £2 billion company. So I would say he understands the franchise market better than anyone else in this country. And they've done a great job. We invested in that company for the first time, maybe even 10 years ago, certainly 8, 10 years ago, that kind of thing. But they've done a fantastic job. And I expect that company to motor for quite a long time.
Do you hold any of these small silver or gold miners? We've been interested, we've been watching the gold price and also watching the miners and interested in the disconnect between them.
I don't. I looked at one yesterday, actually, but I don't. And one of the challenges, particularly with the smaller ones, is costs. Costs move so quickly in mining, and it's a real challenge. It's incredible how quickly the margin is,
eroded.
It happens very fast. So that's a major issue. I mean, you look at things like the price of sulfuric acid. It's so volatile, and it can take a business from profit to loss, in a few months. It moves around so much. So no is the short answer.
Okay, so we'd be better off holding gold and silver.
I think normally at that pace. I think where it's different is at inflection points. So I have in my life, back in 2002, I made a big investment in a private gold mining company where we were just trying to get as much in terms of gold in the ground as possible, with really no intention of mining it.
Just to know it was there.
Just to sell it to someone else. Because if the gold price then was 250, 300, it went up a great deal over the next few years. And suddenly these assets became viable. So I think at inflection points, you can make a lot of money. But once everyone knows the price is high and they know you're in profit, I think it's a tough game.
Well, Mark, that brings me neatly to our final question, which we do ask everybody on the podcast. Although, actually, I think I forgot last week. I think I forgot to ask Diana. Diana, I'm going to telephone you and ask you. If you had to choose between gold, Bitcoin, and you had to hold the one you chose for a decade, which one would it be? Can't be both.
No. I mean, fortunately, I don't have this problem in real life, and I would just
I'd
rather own a business of some kind. But I think I'd go for gold.
I like the doubt.
Well, there is doubt
that?
because
Yeah.
I think with Bitcoin, I think a lot of the doubts around Bitcoin have been addressed. Not all of them, but quite a lot of them. It is used a lot by quite a wide range of people. It's institutionally investable now. An awful lot of family offices and endowments own a little bit of Bitcoin, mainly just in case it goes up 100 times. And then you feel really silly if you don't have it, if everyone else has it.
But that's not a good reason to hold something.
Of course it's not, but that's what people do. FOMO is a real phenomenon.
Although, I hold some Bitcoin just in case it goes up a lot, by the way, so I'm guilty of this one. But that doesn't make it rational.
No, it isn't rational, but it's semi-rational. If someone's buying a tiny little bit, it's like buying an option. It's a hedge, really.
Yeah.
So I think people are doing it for that reason. What I don't like about Bitcoin is its correlations are all over the place. It correlates to gold, and massively exaggerates the movements in gold, but it also correlates to NASDAQ a lot of the time, and it correlates to one or two other things too. So it's a strange beast. If I had to deliver a return of over 100% or 200%, I'd probably go to Bitcoin just because I don't think gold will do that, and Bitcoin could. But if it's a straight choice, I probably would go for gold.
It's a straight choice. I'm not putting those restrictions on it. All right. Mark, thank you so much for joining us today. That was great fun.
Great pleasure.
Thanks for listening to this week's Merryn Talks Money. We will be back next week. In the meantime, if you like our show, rate, review and subscribe wherever you listen to your podcasts. And be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. And keep sending your comments and feedback to merrynmoney@bloomberg.net. And one more thing. For all the people who do not yet know this, Bloomberg has a brilliant website with loads of great content, including my columns, for a very, very reasonable rate. If you go to bloomberg.com/subscribe, you can see the latest offers and sign up to read all our great journalism. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi. Production, support and sound design by Moses Andem. Special thanks, of course, to Mark Slater.